Have you ever wondered why people start spending less, businesses cut jobs, and the economy suddenly slows down? That's what happens during a recession. A recession is a period of economic decline that can affect everything from employment and wages to investments and everyday expenses. While the term often sounds intimidating, understanding what a recession is and how it impacts your financial life can help you make smarter decisions and prepare for uncertain times. We'll break down what causes recessions, how they affect individuals and businesses, and most importantly, what they mean for you. Today we will talk about Recession Explained, what it means for you. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is a recession? A recession is a period of significant economic decline that affects businesses, consumers, governments, and financial markets. It typically occurs when economic activity slows for an extended period, resulting in lower production, reduced consumer spending, declining business investment, and rising unemployment. Economists often identify a recession when a country's economy experiences negative growth over consecutive quarters, although several indicators are usually considered before officially declaring one. During a recession, confidence throughout the economy weakens. Consumers spend less money because they worry about their jobs and future income. Businesses reduce expansion plans, limit hiring, and sometimes lay off workers to reduce costs. 2. Why recessions happen. Recessions occur for many different reasons, and often several factors combine to create economic decline. One common cause is excessive inflation, where prices rise rapidly and reduce consumers' purchasing power. To combat inflation, central banks may increase interest rates, making borrowing more expensive and slowing economic activity. Financial crises can also trigger recessions when banks face losses and reduce lending. Businesses then struggle to obtain financing, leading to slower growth and job cuts. External events such as pandemics, wars, natural disasters, and supply chain disruptions may also weaken economies. 3. The impact on employment. One of the most noticeable effects of a recession is rising unemployment. As businesses experience declining sales and profits, they often look for ways to reduce expenses. Labor costs are usually among the largest expenses for companies, leading many organizations to freeze hiring, reduce working hours, or lay off employees. Job losses create financial difficulties for workers and their families, making it harder to pay for housing, healthcare, food, transportation, and other essential expenses. Even individuals who remain employed may face reduced opportunities for promotions, salary increases, or career advancement. Certain industries tend to be affected more severely than others, especially sectors dependent on discretionary consumer spending. 4. How recessions affect personal finances. A recession can significantly impact personal finances regardless of employment status. Families often become more cautious with spending due to concerns about job security and future income. Household budgets may need adjustments as people focus more on necessities and reduce discretionary expenses such as travel, entertainment, and luxury purchases. Savings become increasingly important during economic downturns because emergency funds provide financial protection against unexpected income loss. Debt management also becomes critical. High-interest debt can become difficult to manage when income declines or expenses increase. Recessions may also affect access to credit, making it harder to obtain loans for homes, vehicles, or businesses. 5. The stock market during a recession. Financial markets often react strongly to recession concerns. Investors may sell stocks due to fears of declining corporate earnings and slower economic growth. As a result, stock prices can fall significantly during economic downturns. Market volatility tends to increase as investors react to economic reports, government policies, and corporate earnings announcements. However, it is important to understand that stock markets are forward-looking. Investors often anticipate future economic conditions rather than focusing solely on current circumstances. Because of this, stock markets sometimes begin recovering before the overall economy improves. Long-term investors who maintain diversified portfolios and avoid emotional decisions are often better positioned to benefit from eventual recoveries. 6. Government responses to recessions. Governments play an important role in reducing the severity of recessions through fiscal policy measures. These measures may include increased public spending, tax reductions, direct financial assistance, infrastructure projects, and expanded unemployment benefits. The goal is to stimulate economic activity and support households and businesses during periods of reduced demand. Central banks also contribute through monetary policy. They may lower interest rates to encourage borrowing and investment, making loans more affordable for consumers and businesses. In some situations, central banks implement additional programs to increase liquidity in financial markets. 7. How to prepare for a recession. Preparation is one of the best ways to reduce the personal impact of a recession. Building an emergency fund is often the first recommendation for financial experts. Having several months of living expenses saved can provide a valuable safety net during periods of unemployment or reduced income. Reducing unnecessary debt is another important strategy because debt obligations can become more burdensome during economic downturns. Diversifying income sources, improving professional skills, and maintaining employability can also strengthen financial security. 8. Common myths about recessions. Many misconceptions surround recessions. One common myth is that a recession means complete economic collapse. In reality, most recessions are temporary periods of reduced economic activity rather than total breakdowns of economic systems. Another misconception is that everyone experiences a recession in the same way. The effects vary significantly depending on employment, industry, location, financial preparation, and personal circumstances. Some sectors may continue growing even during economic downturns. 9. How recessions affect everyday spending. For ordinary households, recessions often become most visible through daily financial decisions. Families may become more cautious about spending because they are concerned about job security, rising costs, or uncertain economic conditions. Large purchases such as homes, vehicles, vacations, and luxury goods may be delayed. Consumers often prioritize necessities including food, housing, healthcare, and utilities while reducing discretionary expenses. This shift in behavior can have a broad impact because consumer spending represents a major component of economic activity in many countries. However, a recession does not mean people stop spending entirely. Instead, they become more selective and value-conscious. Individuals frequently seek discounts, compare prices more carefully, and focus on maximizing the value received from every purchase. This period can also encourage healthier financial habits such as budgeting, saving, reducing debt, and building emergency funds. While economic downturns can create challenges, they often motivate people to become more intentional about money management and long-term financial security. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.